Recently, there has been some decline in the US stock market being led by losses in US technology stocks, which have seen their valuations increase significantly across the past year. Now, vaccination programs are taking place across the world, but most economies are still struggling to recover. In the US, corporate earnings have still not recovered much, and unemployment is still high, with unemployment rate still being above 6% as of January 2021. So despite the decline in the US stock market recently, the stock market prices still appear to be high, and it doesn't really reflect the actual state of the US economy. So the question is, at this point of time, is the US stock market overvalued, or is it still safe for you to put your money in and invest? Well, first, let's take a look at what happened in 2020. Now, the COVID-19 pandemic has affected economies across the world, with global GDP contraction being the biggest since World War II, with a decline of 4.4% in 2020. For the US, GDP decreased by 3.5% last year. Despite the global outbreak, stock markets still managed to generate pretty good returns for investors in 2020. If we look at the table, US equities, emerging markets equities, and developed markets equities have all managed to generate double-digit returns for investors. For this video, I will mainly be focusing on the US stock market, which itself has great power in moving stock markets across the world. Now, the S&P 500 index is a good benchmark for US equities, as it consists of 500 large publicly listed companies in the US, and it is an index that is widely followed by investors globally. This index has recorded a one-year gain of 16.3% for 2020. However, for those investors that took the opportunity of a market crash during March 2020 and bought the index fund during that time, they would have gotten a gain of 68% if they held the S&P 500 index fund until the end of 2020. Table on the right, it shows some of the top performing S&P 500 stocks in the past year. These stocks have generated triple-digit gains, with Tesla leading the pack with a one-year gain of 743.1%. So let us now see if the US stock market is overvalued. Here I have a chart for the performance metrics of the S&P 500 index from 2011 to 2020. This compares the market value of the S&P 500 index, which is represented by the blue line, with its trailing 12 months earnings, which is represented by the orange line. We see that in 2020, corporate earnings have declined due to the pandemic, yet the index continues to climb upwards in value in the opposite direction, causing a divergence. So this has resulted in an increase in the S&P 500 index price to earnings ratio, which equals the total market cap divided by the trailing 12 months earnings. Now, the larger the gap between the stock prices and the corporate earnings, the higher the price to earnings ratio, and thus the more overvalued the stock market is, and thus riskier for an investor. Here we have a chart of the price to earnings ratio for the S&P 500 index across the long term. Now, the price to earnings ratio of the S&P 500 stands at about 39 times, which is more than double its historical mean of about 15.9 times. Although this valuation is lower than the spike reached during the global financial crisis in 2008, however, it is still fairly high compared to long-term past records. Now, other than the price to earnings ratio, another popular indicator to determine whether the US stock market is overvalued or not is the Buffett indicator. The Buffett indicator is the ratio of the total market valuation of the US stock market to the GDP of US. The most common measurement of the aggregate market value of the US stock market is the Wilshire 5000 Total Market Index, which represents all publicly listed companies in the US. Now, this indicator is popularized by Warren Buffett, as back in 2001, he remarked in a Fortune magazine interview that It is probably the best single measure of where valuations stand at any given moment. If we look at this Buffett indicator chart, we see that the average is about 75%, and there have been some spikes over 100%, and also some periods where the ratio is below 50%. Now, a higher ratio means that the market is more overvalued and thus more dangerous and more likely for a correction or a crash. We can see that the ratio as of February this year is already close to 200%, which means that the market is valued at nearly twice the value of the entire gross domestic product of the US economy. And this is even higher than the levels reached just before the dot-com bubble bursted in 2000, and also just before the housing bubble bursted in 2008. And it seems like there is a technology bubble as investors have been chasing technology stocks to record high prices. According to Warren Buffett, if the ratio approaches 200%, you are playing with fire. And, well, it appears to be the case now as we are close to that figure already. So what has propped up the US stock market so far? It is not due to a vibrant and growing economy whereby companies are generating record high earnings. Instead, it is attributed to the expansionary monetary policy of the US central bank, whereby the US Federal Reserve prints new money in order to buy bonds from the open market in order to keep interest rates at a level low enough to boost economic growth. So when interest rates are low, generally investors will move their money from the bond market to the stock market where the returns can be higher. So that has been what has been driving up the demand for stocks and thus stock prices going higher. Now, the US Federal Reserve has committed that it will purchase at least $120 billion worth of fixed income securities every month from the open market. And it also maintains to keep interest rates within a targeted range of between 0% to 0.25%, at least until the inflation target of 2% is achieved. So if vaccination programs are effective and the US economy recovers faster than expected, then at that point of time, if the inflation target is reached, the US Federal Reserve will then reduce its monthly purchases of bonds from the open market, and interest rates will rise. And if that happens at that point of time, there may be a stock market correction. Apart from the expansionary monetary policy being pursued by the central bank, the US government is also spending a lot of money on stimulus programs in order to boost economic growth. However, the increased public spending has been putting a lot of strain on government finances, resulting in the US national debt rising significantly. As of the third quarter of 2020, the US national debt to GDP ratio stood at 127%, which is around record high levels. And under the Biden administration, public spending is expected to increase further. The US government is currently discussing to have in place a $1.9 trillion stimulus program, and this will no doubt put more strain on government finances. So how is the US national debt being financed? Well, the US Federal Reserve prints new money and then uses this new money to purchase government bonds in order to finance the US national debt. Now, as the central bank prints more money, the supply of USD increases. This leads to a depreciation of the US dollar. That is why investors have been reducing their cash holdings and instead putting more money in gold or cryptocurrencies like Bitcoin, which are expected to hold its value in the face of inflation. Now, what do other investors think about the US economy and stock market? Howard Marks, founder of Oaktree Capital Management, the largest investor in distressed securities worldwide, said that the stock market does not seem to reflect economic reality. The world is combating the greatest pandemic in a century and the worst economic contraction of the last 80 plus years. However, the stock markets appear to be racing ahead of fundamentals, nearly recapturing an all-time high that had been achieved at the time when the economy was humming, the outlook was rosy, and the risk of a pandemic hadn't registered. Now, on the more optimistic end, there is Bill Ackman, CEO of Pershing Square Capital Management. He said in December 2020 that with the accelerating distribution of COVID-19 vaccines and the release of pent-up animal spirits, businesses and their consumers will be raring to travel and spend again as we head into summer of 2021 and beyond. So a recovery can be expected from quarter 2 of 2021 onwards. People haven't spent, people haven't gone out to eat, they haven't gone to the theater. So when they're able to do so, you are going to see a huge recovery. So retail stocks will be expected to rebound in the second half of 2021. He added that this is good news for well-capitalized large organizations as they may be able to gain greater market share given that the pandemic has driven away many of their smaller competitors out of business. Now, for Ray Dalio, the founder of Bridgewater Associates, the largest hedge fund in the world, said that his fund's bubble indicator, which takes into account 6 measures to determine whether the stock market is in a bubble or not, has been showing warning signs. He said that for technology companies in particular, 3 of the 6 measures were flashing bubble sign, including many new buyers in the market, broad bullish sentiment, and purchases being financed with credit. He said that this is reminiscent of the Nifty 50 in the early 1970s and the dot-com bubble in the late 1990s. And about 5% of the top 1,000 US companies are in a bubble. So do you think that the stock market is overvalued at this point of time? Are you continuing to put your money into the US stock market, or are you investing in alternative assets? Or are you just holding on to cash waiting for the next market crash? Well, 2020 has been a volatile year and 2021 is expected to be volatile as well. With the US stock markets being at record high valuations and it does not seem to align with the actual state of the US economy, coupled with the high US national debt level, it may appear risky to be putting your money into the US stock market now, especially if you have a short investment time frame. However, if you are a long-term investor and you employ a dollar cost averaging strategy whereby you put about the same amount of funds into the stock market no matter how the stock market performs, then you will have lower risk. This is because any short-term fluctuations will be smoothened out over the longer term. The gains that you make during your good years can be balanced out by the losses you make during the bad years. So on average, they can still give you a reasonable return. Take the US S&P 500. It has managed to generate a historical average rate of return of about 10% across the long term, which is not too bad. Nonetheless, it is good to keep some spare cash on hand for emergency use or any rainy days. And if a market crash does indeed happen, then at least you will have some cash to deploy to buy stocks at attractive discounts. Also, remember that past returns are not necessarily indicative of future returns. So whatever stock or asset you decide to invest in this year, however you structure your investment portfolio, please be mindful of your own investment goals, your objectives, your time frame, as well as your risk levels. Invest safely and you will reap the returns over time. Okay, that is all from me for today. If you enjoyed the video, please smash the like button and also subscribe to my YouTube channel and turn on the notification bell so that you will get updates when my next video is out. Alright, that's all for today. Thanks for watching and stay safe.